Hi, good morning, everyone. I welcome you all for today's session. My name is Vijay Veer Singh. I'm the Vice President at Amity Innovation Incubator. So let me just give you a brief intro of Amity Innovation Incubator before we start off with today's session. So we take immense pride in introducing Amity Innovation Incubator as a very comprehensive ecosystem in India. We started our operation way back in 2008 under the aegis of our Honorable President, Dr. Asim Chauhan sir, with a vision to ensure a comprehensive ecosystem is in place to nurture entrepreneurs and strengthen innovation culture at the grassroots level. We are honored to be supported by Ministry of Electronics and Information Technology under TIDE 2.0 scheme. During our journey of more than 15 years, we have impacted more than 650 plus ventures and have aided investment in 75 ventures through Amity Capital Ventures, which is our investment vehicle. We would like to express our gratitude to Ministry MSH for providing their continuous guidance and support. As we have gathered today for another interesting session on funding compliances for incubators and startup, I'd like to welcome here my very good friend as well as the senior consultant with Startup Movers, Mr. Sambhav Mehrotra. He actually has been he has been supporting the startup ecosystem for very long now, and so his name is very popular among all the startup side of it. But let me just introduce in a very brief mode. He's a first attempt qualified chartered accountant working with startup ecosystem for the last 10 years. He has seen through various investment closing rounds and plethora of learning as well as from failures of the startup industry. He specializes in setting up the backbone, that is the financial and legal structure of startup. Besides managing about 100 startup on a relationship model across various domains, he is also a seed strategic investor in few of them. He also act head of finance slash VP finance with 91 Springboard and helped the company set up the initial team and finance function for exponential growth ahead. I welcome you on board for this session, Sambhav. Over to you. And what we intend to do is any Q&A questions from the participant, we request you to put up in the Q&A section. And at the end of the session, you may also raise your hands. We'll get you online for a one-on-one discussion with Sambhav. Thank you. Welcome once again, Sambhav. Over to you.
Thank you, Innovation Incubator and Mighty Startup Hub for setting this up and having us discuss this critical topic as a mutual learning with the ecosystem where we have both incubators and startups alongside. Practically, whenever we've been doing these seminars, workshops, or deliberations, we've been focusing more on the founder side. But it's a privilege to have a balanced approach in today's topic and focus on both the areas and both the sides for a balanced growth at both ends. So welcome all on this topic of best practices for funding compliance for incubators and startups. We have a slide, but the manner in which I personally prefer to do this is more quirkiness, more participation, and more mutual learning. So we'll have a restricted time on the slides and we'll want a better participation at the end. We have a little slide that we'll go through and we'll pick up the questions as already discussed at the end of it. A little bit about Startup Movers. Of course, there is a slide that has a little bit of content, but if I have to summarize, if whatever complicated and complex compliance situation you can think of in a finance and legal space for any startups of any stage, Startup Movers is the team to provide you a simple solution for the same. We do the simple, but our expertise lies in solving for the complicated issues that need simple solution for founders, incubators, or investors to escalate or to basically make the growth efficient and effective for the startups. And they don't wait, the founder doesn't have to spend a lot of time in solving those complexities. So I'm myself a general practitioner. I have taken startup field as my area of expertise, but within the startup ecosystem, I am a general practitioner. There is a team of star experts around who are subject matter experts. So for the person, there's one point of contact, but that for the founder, it becomes easy to communicate. But at the back end, there's the whole team solving for the holistic requirements for whatever startup needs on the legal and finance landscape. One slide that we've been talking of, including since the last 4 years, 5 years, in all these deliberations is this one slide of demographic dividend. We know our population size, but the good part there is that we have entered a phase effective 2018, where we need to reap the benefit of the demography that exists in our ecosystem economy. It's a challenge, but it's a good challenge to have given the population size we have, because the history tells us that during this period, the countries that have gone through this period have grown much faster and have developed much faster. There's Japan, there's China, there's Italy, then there are other developed nations who've already seen this period. So we are just at the brink of starting of that period. It's just been 4-5 years, of which some of that has already gone through a tough COVID period. But if we look at the numbers that are now coming out, where India stands in terms of the economic growth as compared to the rest of the world, we know those numbers speak something for us. And the good part is not creation. The difficult part is sustaining that growth path. And what lies ahead of us is both an opportunity and a challenge, where the startups and MSMEs are going to be a big catalyst, a big pillar to give this benefit of the demographic dividend that we are going to enjoy for the next 3 decades. And all of us, not just on the call, but as an ecosystem, we have a responsibility to ensure that we make the best out of it, not just for us, for the ecosystem, but for India as a whole and for humanity as a whole, because India stands at a very, very critical juncture right now, not just for itself, but for the whole world itself. So coming to the topic, funding compliance for startups and incubators, we'll talk about a lot of general topic in this, so it could become a little boring, just bear with me. But we'll try to bring in as much quirkiness as possible so that we can make most out of the mutual communication that we'll have at the end. To begin with, let's just talk about where does incubation fit in the startup life cycle, right? So if we, this chart, of course, is the source of the chart is from somewhere else, but it clearly demarcates in terms of a category of startup, in terms of life cycle of a startup. And usually at the incubation stage or the seed stage where incubators are involved, it's stage 1 or stage 2, sometimes 3, 4, 5. But as that personally I'll count as an exception. But when a person from e-cell comes out, or somebody who's trying to have the earliest money for, so then you might have a problem and you're just looking for the solution fit, where your company is still not incorporated, you're still thinking about multiple solutions. Usually at stage 1 or stage 2 is where we'll see most of the incubation money coming in or incubator support coming in, where you have to be brought up into a framework. And that is also an area of highest failure rate as well, because once you found a product market fit, you still have a little bit of iterations, pivot of opportunities. But if your MVP is itself, you're not even able to go to the market with a MVP, then the struggle still continues, and resources runs out, and it's difficult to raise money post that, which is where till that stage you have the incubation support, which is where you need the earliest of the supports in not just in terms of other modalities like how will the marketing function work, how will I find my co-founder. It also is about this session also of how legal and finance works, what could be the best practices to secure the framework that we are trying to build and ensure the success matrix. What we are trying together to achieve through such sessions or doing any such activities through MIT incubation, MIT or us is, at the end of it, we want to improve this success rate that exists in the Indian startup ecosystem. We all know globally how high that failure rate is. But in this Indian ecosystem, we want to set up a benchmark that if everything works together, the success rate can grow higher. And that's where at stage 1 and 2, if the right set of resources are provided to the founder, to the product, to the system, the success rate eventually can improve, and that can be benchmarked as well. So as a startup, so we talk about these slides where there is a mix of what startups need and what the incubators will need. So we'll have to look at this deck from both ends. So whenever I speak on a slide, it doesn't just mean that we are speaking on what the founder's mindset should be. I think it's also going from the mindset of what incubators need to tell to the early stage founder whenever they are trying to approach any incubation itself or an investor or any kind of resources that are available in the ecosystem. The first and the foremost is what is the problem that you're trying to solve, and is it actually worth solving, which is where I'll come to the second point as well, which is linked. How far along is your prototype? Because ideas will never be the good thing, right? So you look at a lot of these quirky videos. Yesterday, I was looking at a video with somebody who was talking to Ashneer Grover, and he said that I have an idea where I'll create a monopoly and I'll kill the market. So the question was, what is the idea? And then again, the same sentences you will keep on hearing from those who kind of achieve something is ideas don't matter. You can have hundreds of ideas. What matters is execution. Whether you have that execution skill, or whether you'll be able to bring that execution skill together to give meaning to something, right? No idea is a new idea. We can go around in the ecosystem and we'll find something or the other. Of course, you might have patents, trademarks, intangibles, but you might have some similarities on somebody else also trying to solve for, maybe not exactly what you would have thought for, but the mechanism could be the same, the end result could be the same, the methods could be different. So what initially needs to be done is don't run after valuation. Don't run after the stardom. Run after what you are trying to solve for. That is important, and how big that problem is to solve. That should be the essence of creating anything in an entrepreneurship or a startup ecosystem. We've gone through various incubators in the last 5 or 6 years, and without naming them, the differential approach that we've seen in the cohorts is actually what kind of problems the cohort is trying to solve for, which is kind of differentiating both the cohort and the incubator itself, and then the end result of the success of the startups. The other thing that you need to look at is what kind of expertise you have and what kind of expertise you have capability to build. You are coming fresh out of academia, and you have a network, but that is not a network that you can rely on to build your best management expertise, which is where Incubators Accelerator comes in, where you want to build that expert level at after a stage, and you should start thinking on those terms even when you're approaching people, because you will want to bring on people who can bring in their expertise as well. And then, as we said, don't run after valuation. Is your valuation even legitimate? We know that if you look at the valuation systems that exist in our ecosystem so far, at least prior to funding winter, of course it exists today. Technically speaking, we are from a technical background. We've always found this valuation negotiation more of an art than a science, because art comes first and the science kinds of validates it later on. But we've seen what has happened already with listed startups, what kind of valuations they demand. We are now looking at a lot of down valuations that are happening even at a unicorn stage. So this was about to happen. We believe it was a cycle. And the good part is now we are restarting that cycle again. And that period is about to come in another 4, 5, 6 years down the line, when we'll again have that kind of a liquidity in the ecosystem, more matured ecosystem. And at that point of time, personally, I believe it will not be again a game of pomp and show, and the valuations and the unit economics will actually matter. So even from an incubation standpoint, training the founder or the cohort that you are selecting on unit economics is going to be a very, very important part, where whether the unit economics sustains, and even if a pivot is needed, whether the unit economics sustains or not will be a very, very important thing to look at. When we talk about funding deal sequence, right? So we call fund syndication, or we call a deal closure, right? So when do you feel a deal is through? When you sign a term sheet? No. When you do an SHA? No. Whether money lands in your account? No, that's not the end of the deal, because deal cycle itself is in stages and has multiple things involved. And unless you close the last milestone that needs to be done, the funding deal has not officially closed. And we've seen, when we'll talk about it in the future slides also, what repercussions it has in your subsequent round. And specifically at this stage, incubation stage, seed stage, where there is not much of a data to be looked at. And it's more of a gut feel or an instinct or like management expertise on which we are going ahead with. And hence there are misses that happens in this whole process. So if you have to divide the whole deal sequence, there's pre-deal, there is during deal, and then there is a post-deal thing to be done. Pre-deal, you need to understand what kind of money you need, because whenever you approach an investor, or say if you are looking for a grant, or if you're going for a program for an incubator which has a restricted fund size, you need to understand what that fund is going to achieve for you and what kind of milestones you are going to achieve from it. And if an incubator is kind of investing in you, are they leading? Are they co-leading? What kind of round it is? So you need to, as a founder, you need to have an insight on how much you want to raise to reach to a certain milestone, because your investors definitely will ask for it. even that at an incubation stage, we will need to build that thought process that even if it's an incubation amount that's going to a startup, what kind of targets or milestone they will have to achieve and inform the incubator about it timely. Then finding the right investor, public incubator, because incubators have different programs in which you can fit in. So you need to do a right research on what kind of incubators are going to be the best for the startup. Similarly, for the incubation side, what kind of cohort they want to actually build up, not just in terms of industry type. They could be sector agnostic incubations, and in that they could be filters for what kind of founders we need. The third is what kind of instrument we want to have, what kind of instrument founder wants to give, and what kind of control will the incubation or investor will want to have, and define the kind of instruments that will be used. We'll talk about instruments in the next slides. And then finally, once all these is done, you kind of agree with the investors on few initial terms, which will then convert to your future documents. And the primary document that becomes there is a term sheet or a valuation. In case of incubation, it will be an incubation agreement, which will kind of define the terms and the valuations that will set in. Once that is done, you sign the term sheet. During the deal, there are a lot of things. At incubation stage or at seed stage, we might not look at DD in that perspective because there is hardly any data to look at. But what we will stress, and we'll talk about it in depth in future slides, is even at this stage, DD is critical. Even if it can be a standardized DD, it can be a limited DD, but DD is still important at this stage. That can give us some insights on the next round that's about to happen, what we need to be prepared for. And then during the deal, whatever term sheet is coming through, that needs to be converted to certain documentations like shareholder agreement, share subscription agreement, which defines a lot of roles, responsibilities, rights with investors, founders, and every related party that will be a part of that agreement. We'll talk about what is condition precedent and what are pre-money compliances in future slides, which basically during the deal will set up what needs to be done to close the deal, which is practically what these two sentences are talking about. And once all this is closed, you've got the money in your account. You need to do post-closure, which is filing necessary ROC filings, MCA filings. And we'll also talk about, as I said, there's a full deck on this, full slide on this, that what constitutes post-deal closure, which is where we should say that round has actually closed. What this will help us in is call for money, a faster call for money in subsequent rounds. We'll talk about it in future slides. What are the kind of factors a founder should consider while raising the funds? What are the growth and expansion needs? What are the plans for the future? Do you have a projection in place? Do you have those matrix and unit economics that you can explain even at an early stage? Usually what we've seen is, again, different cohorts might have different visions to it. So when we talk about incubators where there's scientific research happening, there are patents, there are technologies that are coming out. They might not have revenue upfront. They are creating something that might or might not have a value. So even if you have a patent that you have developed through an incubator, unless you make it commercially viable, that doesn't make any sense. So the whole thought process needs to go in that if the patent actually becomes commercially viable, what it's going to solve for, what kind of revenue can come in, how much that can patent be sold for. All that needs to be thought through in the earlier stage. What could be the long-term and short-term capital needs of the business? The next is what kind of strategic expertise you need. Just give me a second. Apologies for the small delay. I just changed my network. So next, what we've thought about is what kind of long-term capital needs you will need in terms of your product launches, what your market expansions will look like. And then the most important part at the earliest stage is what kind of expertise you need, right? At this stage, you just don't need the money. You need strategic expertise. You need subject matter experts who can give you network, who can give you mentorship, who can give you community that you can kind of leverage, right? Then next is your dilution and profit sharing. What kind of dilution you want to keep? What kind of profit sharing in terms of We'll not say profit sharing in a startup ecosystem because revenue comes at a very late stage. But assume that you are in an ecosystem where you are having a business model where you can become a cash cow in 1 year's time. What kind of dilution you will want to do at early stage? And then that brings us to the next slide of how you can leverage debt, right? In incubation stage, of course, debt doesn't count because more or less it will ideally be a grant or ideally be a strategic instrument-based investment. But there could be scenarios where, like in case of SIDBI has certain programs, there are collateral-free loans for startups. Are you eligible for it? Should you be considering it at a very early stage? There are products that you can look at a very seed stage or an incubation stage as well, where you can look at whether you will have a repayment capability, say in 6 months' time, you will have a product that is going to generate revenue. Will it meet your short-term needs, and then you are able to sustain and raise a bigger round for your expansion? The biggest part is whether you will be able to meet the interest cost of that fund or the debt that you raise. The biggest benefit of debt leveraging is you are not diluting your equity, right? So the higher you leverage debt, not just as it seed round or say later rounds, the higher you are in a position to leverage debt, you are in a better position to lower your equity dilution. And then, of course, there are instruments which are debt-based. We'll talk about it in the next slide, which might or might not convert to your equity. So if they are converting to some instrument, some equity, you will need a valuation report. And if they are repayable on demand, then of course you don't even need a valuation report in that sense. Coming to type of instruments, we hear of equity, CCPS, CCDs. We'll just talk about in a little depth of what these instruments are, who can use those instruments at what stage. So typically at a incubation stage, we will see these three: equity, CCPS, and CCDs. Equity is a common stock of the company which founders own, which has absolute voting rights. But the part is there is no liquidation preference because equity is the promoter of the company. And you sit in a space where you will be paid at the end if something goes wrong, right? So that's why when we say no liquidation preference, so if there is something wrong that goes with the company, there are few assets in the company, equity will be paid at the end. At the same point of time, if you want absolute control of the company, you will kind of need to have an equity share in the company. So you will see sometimes when you raise rounds, people along with CCPS will kind of take 10 equity shares or 1 equity share as well, so that they have some sort of a control mechanism as well. Because through CCPS, they have a liquidation preference, and through that equity, they have certain powers which they can exercise in terms of decision making. So there will be few rounds that you will see where people take CCPS along with a little equity. Then we come to CCPS, which is compulsory convertible preference shares. They are convertible at an equity to an equity at a future date at a convertible price. They don't have a common voting right. CCPS don't, and that is why when you execute documents like SHA, you have to amend your article of association, charter documents of a company, memorandum and article. So you will see that whenever CCPS allotments are done, there is requirement for amendment of articles for this reason that there is a deemed voting right that doesn't have in these instruments that we need to create through the contractual obligation. The best part and why people choose CCPS or CCDs over equity at early stage investments is reference to liquidation, right? That if something goes wrong, CCPS will be paid prior to any equity payout. So if there is limited amount of asset and limited amount of resources that are to be distributed, CCPS owners will be paid first. And then they have an anti-dilution clause through which if there is a down round, so if you raise money, say X at X price today, and tomorrow that price, instead of going up, went down, there is an anti-dilution protection as well, where the conversion price changes and you still end up owning the same amount of percentage in the company when you convert. That's about CCPS. It's another instrument. It is in terms of representation, it's counted as in equity only. So if you look at your financial documents, CCPS equity will form as your share capital. When you come to compulsorily convertible debentures, they are hybrid. I mean, when you represent them on your balance sheet, they are debt instruments. They will not come into a share capital. They will be shown as a debt, though they have to be converted to a equity at a later date compulsorily. There are certain conditions or there are certain milestones on which this conversion happens. In a hybrid, when we say hybrid, it is represented as a debt in the company. But as we said, it actually converts to a equity at a later date in any case. Similarly to CCPS, they don't have a voting right. So you have to amend the articles to give them the voting rights. And then there is a discount rate and a floor value. So where CCD comes into the picture is where you don't want to do a price round today. So if I talk about what is the difference between a price round and a floor and a cap round is, I actually don't know the valuation of the company as of today when I go back to the investor, because it's a pretty new market, it's a dynamic market, things will change faster. So instead of doing a price round where we and both the investors and the founder don't agree that there is a potential fixed valuation that we can keep, we keep a floor and a cap. We'll say that my valuation will be minimum X if I go on to raise my next round, but you will not be converted beyond Y. So there is X and Y, where X is X and Y are floor and cap. And CCDs typically are used as an instrument there. Sometimes CCPS also, where we want to convert these CCDs whenever we raise next round into an equity. Of course, because the money came in early to us, there will be some IRR discount to it. So when you convert this compulsory debentures, whenever next round is raised, you can, the compulsorily convertible debentures holder get certain benefit of that IRR discounting, and they end up having a little bit more equity as compared to the next round that is being raised. Usually at incubation stage, we will see a lot of CCPS that comes into picture, if not grant. CCDs we will not see a lot. CCDs will come in at a little bit later rounds. It can be, CCDs can be at an early stage round also, but as we said, right, the most at incubation stage, CCPS kind of in the ecosystem is the most preferred instrument to go ahead with in case we want to have a participation round, if not grant. Then recently, after 16, when the Startup India policy came in, and there was a concept of convertible note, which was very, very prominent in the West. The Indian startups were not able to raise money through debt. The fundraising exercise was very complicated. It today is as well. If we compare to fundraise in a country, South Asia Pacific or Middle East, raising funds is an easier task there in terms of compliance as compared to what we do here. If we do apple to apple of what existed 5-6 years back and today, from Indian context, we've improved a lot. There's a lot of ease of doing business, but there is still a lot of way to go where trust needs to come into the ecosystem and the fundraising needs to become a little simpler process. One thing that has happened in that foray is convertible notes, where the company law restricted companies to raise money as debt from any public person apart from shareholders and directors. But through convertible notes, you can raise money as a debt from any person. If you are a Startup India registered company, you have a DPIIT registration, then you can raise money through convertible notes. As an incubator also, if you are investing a ticket size of 25 lakhs or more, it can be a convertible note, because the minimum requirement here for a ticket size is 25 lakhs. These are convertible to equity shares, but repayable as well. So if the note holder and the founder, they have an option to repay this note, but it can convert to a equity also based on certain terms, but it cannot cross 10 years. So within 10 years, either it has to be repaid or it has to be converted to equity. A pretty simple way to raise funds as compared to other like CCPS, CCDs. Convertible notes are easier to be raised in terms of timelines, call for money. The fund utilization can be much, much faster. And lastly, there is iSafe notes. This is again a recent phenomena. When we say recent, about 2-3 years, we are aware of Y Combinator in US. They use something called safe notes, which is recognized there as an instrument. But when you say iSafe notes, it's more or less, this is my personal viewpoint. I'm open to discussion here later. But this is more of a instrument. It's not an instrument, it's a method, it's an agreement, because the first time when we did iSafe, we realized we had to amend it a lot, and ultimately it became a CCPS allotment. And then later on, there were some public notifications, and where we saw that it's iSafe note, but the underlying instrument here mostly is CCPS. We're still evaluating, internally the team is evaluating, can it be CCDs also? But more or less CCPS are used in iSafe notes, and it's based on certain liquidity event. It's just that the terms and conditions are standardized in one sort of agreement, which is what we are calling as iSafe. But the underlying instrument, again, there is CCPS only. The terms and conditions are standardized through a note, which is what we are calling as iSafe note. Moving on, what constitutes, what kind of team you will need to close a round? Even say at incubation, when an incubator is giving in a money, of course, now incubators have these support systems, pretty aligned, pretty standardized. But just to look at it again from a bird's eye view, whenever you want to close a round, you have a standard set of term sheets which can be signed. Usually at incubation stage, you will standardize things and move forward. As a founder, if a founder is bringing in a term sheet which incubator wants to see, or if a founder wants to look at a term sheet that incubation has standardized, should he go ahead? Maybe he can take a review of it. Does he have a skill set to understand the nuances? Maybe, but most of the times not. So it's important to have a little bit of review from a legal and a law firm if they are not creating it at incubation stage. But of course, for future rounds, whenever such things happen, there is a requirement of a corporate lawyer who understand these corporate laws around, specifically around fundraisers, who can assist you in negotiating those terms over the term sheets that will eventually convert into the master document, which is the SHA and SSA. So you need a law firm that is, or a person, he might or might not be a lawyer, but we are talking about a skill set to exist, who can have an expertise in understanding those nuances and the critical aspects. We'll talk about those. That's first professional that we're talking about. Then you need to complete secretarial compliances, because as I said, right, and there is not just one form that goes when you raise fund. There are multiple forms that you need to file with ROC and other authorities to close the round, where you need a support of a company secretary or a CS firm. This could also be some other professional, but for the sake of it, we're assuming that it's one more professional's requirement. So the milestone that we're talking about, legal, company secretary, it could be one person, but these are two set of different skill set that needs to be there. Then third, majority of the cases, if it's not a CCD or to a resident or a convertible note, you will need a valuation report, because that's again a tricky part in an Indian ecosystem. Income tax says some valuation report, ROC says some valuation report, or the MCA, and then the RBI will say another set of valuation report. So most of the times, just one report could be sufficient, which is the registered valuer report. Earlier, we used to have just the chartered accountant report, and that was it. But now there is a separate professional body that has been created just to have valuation as an expertise. So as a startup founder, or say as an incubator, sometimes you will have to stress on this valuation report. And for an early stage investment of about 20-30 lakh rupees, there is a substantial, I would use the word substantial because it's a compliance cost that goes through, that needs to be incurred at that point of time. And if it's a non-resident, you also need a merchant banker report or a chartered accountant's report. So that's the third milestone. We are again talking about another professional that comes into the picture. If you're raising money from abroad, from foreign investors who are putting in money through FDI in India, you need to report your compliances to RBI during the fundraise, post the fundraise, annually, and it's an ongoing exercise. So you need a FEMA expertise to come in whenever you're raising funds from foreign investors, right? And then finally, for your tax planning, for the framework setting, you will need somebody who understands your business long term, whom you have a professional relationship in terms of holistic understanding, where they will give you insights on how does that whole framework or the round look like for the future aspects of the company. So as a fundraise, it might look like it's just a one-person job, but it's actually not. It involves a lot of different mindsets. There could be a case where one person has all these skill set to solve for, but truly speaking, there has to be a team to solve for it. And that is why early on rounds, we might not see a lot of problems, but whenever we go to a subsequent round, post incubation or post seed stage, there are certain misses that we see in this area, which becomes a part of the due diligence. We'll talk about it. And as I said, there are two things which we are focusing on: how you can do the call for money faster, how can incubation invest faster and startup founder can use that money, and how we can increase the overall success rate by being compliant to these legal and financial requirements. So this slide just talks about a bird's eye view of what kind of skill sets are needed to close a round. We'll just talk about in few slides on term sheets and a little bit on why those terms are very important, because in most of the cases, what we have seen is there is right that is available to the early stage investor or the incubator, but they are not stringently followed in terms of what it kind calls for as a KPI management for that cohort or the startup. And we'll talk about a few of these that can help us shape up a startup or a future round better. So term sheet, SHA, SSA, most of them will have these common terms. There will be parties to the agreement. They will the company, the founders, the incoming investors, and sometimes maybe advisors. They are party to the document. The document will talk about how your cap table will look like, what's your valuation, what kind of money you are raising, what's the round size, who are you allotting the money to. So that basically is the basic of these documents. And what kind of instrument you want to use: equity, CCPS, debentures, convertible notes, or ISAF. Usually, the agreements or the documents will talk about, should talk about. In some cases, it might not. They could be standard agreements early on. What is the founder vesting, right? You need to have very common term. I kind of hear it every now and then. Skin in the game, right? You want to have the founders having skin in the game as late as possible, and you want to create a framework where these documents are the best of these documents are those that are never used in the code of law, right? That's how they should be framed, that they are never used. Because just having these documents, and I'll talk about one more document with this slide, which is the co-founders agreement, which should supersede this three documents. Ideally, I should have had a slide here. But at an incubation stage, what incubators should motivate and should get done is the co-founders agreement, right? Two of the biggest reasons of failure, we'll talk about it in depth: co-founder conflict and investor dispute. Both of these can be mitigated with well-drafted documents, because once those are agreed upon, once those are thought through, then the thought process or the acceptance for some kind of a adaptation at both ends is higher. Versus the absence of it will always create a environment where the dispute might not be that major, but it will keep on rising like a bubble, and then all of a sudden a very good idea that was being executed perfectly goes for a toss. So founder vesting is important in co-founders agreement as well as in all these documents. For how long you will want to lock in the founders, what happens in case they do not end up, one of them does not end up continuing the role, how will they give their shares back to the company, and all of that needs to be captured and informed at a very early stage. Next is right of first refusal, where if anybody wants to sell those shares and have a third party buyer outside, they have to come back and first offer those shares to the existing shareholders who have a right to refuse those, and then he can go and sell those, which is, this clause is more from the investor's side, which we see more often than not existing in these agreements. And then the other is ROFO, which is right of first offer, where there is no third person offer in the market. This is more from the founder's side, where they can kind of acquire the investor's shares if they want to sell it at an agreed price based on certain valuation, not on a third party matter. And some of the other important aspects, there's tag along, drag along, right? Tag along is for giving protection to the minority shareholders, that if the promoters are kind of selling off the company, they will tag along and they will get the price for those shares. Founders cannot sell if investor securities are not bought. So that clause should always be there. Then similarly, on the opposite side is drag along, where investors have right to require founder and minority shareholder to sell his shares if the buyer wants to acquire the full company. These are two pretty prominent clauses across these agreements. And then another aspect to look at, which comes at a very late stage in a startup life cycle, is ESOP allocations, right? So typically it's about 8 to 10% early on. Usually startups do not create a formal ESOP policy unless they go to an angel round or a pre-seed round, where they'll formally have a ESOP policy coming in. Until then, they'll just keep on showing a provision on the cap table that we have a pool. I think early on, this knowledge share needs to be done to the founders and early employees at how ESOP works, why it should be created early on versus just a provision on the cap table, and how will this shape up in future? Can this be increased? To whom can these shares be allotted to? Can investors and founder get these ESOP pool? If yes, what kind of mechanism has to be followed? So ESOP becomes so ideally in early stage documentation, all you will see that at the end there will be an allocation of the ESOPs. but there might not be a policy as such, which will come on later in the life cycle. Then next is the board rights. At early stage or seed stage or incubation stage, you might not be willing to take a directorship role or a nominee role in the company, because that also commands a little bit of responsibilities as well. So we will see at pre-seed A or Series A stage where institutional investors or angel groups will have a clause in the agreement that they will want to appoint a nominee director later on, or will want to have 1 or 2 board seats reserved for them. The agreement will say what will be the quorum of meetings where decisions are taken, right? There is a deemed quorum as per the company's law or the article. They might want to have a change in the quorum based on who the investors are. And then a consent on the reserve matters. We'll just discuss what reserve matters are and why they are so critical. This is very important information, right? As an incubator, as an investor, you have a right to have business plans, projections, monthly reporting, half-yearly reporting, audited financials, compliance reports. This is critical right that you have, that kind of needs to be executed in a strategic manner at a very early stage if you want to build a culture of good corporate governance in the early stage startups. We'll talk about it. And then there is reserve matters, where there are decision making that you will want the ongoing founders, directors to do, but there will be certain things which you do not want them to take without a consultation from majority of the investors, which ideally the law might allow them to do. But through this document, you are creating restrictions for those founders, that in case they want to hire an employee at more than 5 lakhs a month salary, in case they want to change an ESOP policy, in case they want to geographically expand, and all sorts of those things become matter which we call reserve matters. जिनके ऊपर the investors will always have a right of a prior consent, that without that they cannot move. So we've seen cases in the past where founders have done the SHA early on, raised a very small amount, 30 lakh, 50 lakhs. Next round they're raising is 5 crores. But the previous round had reserve matters which the incubators or investors didn't exercise, and they were supposed to have approvals from all the investors which they didn't have. So that can kind of send the wrong message to the incoming investors as well. And as I said, the idea is faster call for money. So it might not be a tipping point where investors say, oh, you didn't take the approvals, I'll not invest. Because they might still invest in the subsequent round, but they will have their eyes and ears much wider open. And the flexibility that you might need as a founder might not be there. So it's better we have a good corporate governance at an early stage itself, which kind of converts to faster round closures and higher success rates in future rounds. Again, there's liquidation preference. Like we discussed, there are different type of instruments. Since we take CCPS or a CCD at an incubation space, whenever something will go wrong, which ideally does in most of the startups, most of them don't succeed. There is asset distribution that needs to happen. Most of the times, there is an investment write-off that is there. But in case there is substantial assets in the company, there is liquidity event that happens. There is a certain preference that's given to the investor instrument in case the resources are available. And investors who raised at higher valuation will always be given more preference, and that's the chronological order that will follow. Then you have an anti-dilution, that as an incubator or investor, if you're putting money at certain valuation, we've discussed it in previous slides, we need to protect your percentage in the company. And if there's a down round, there are a few methods through which we can maintain your dilution, your anti-dilution in the company. You can continue to have the same proportion or same percentage of the company as an ownership. And then there is preemptive rights. Basically, preemptive rights, which is the last one which we'll discuss on these documents, is whenever there is a future round, even as an incubator, you will always have an option to have a first right to invest in the company if a future round is raised. So the founder and the company will should come to you whenever they are raising a new round. And if there are opportunities that the incubators have their own AI funds, there are dedicated funds to even invest at a growth stage, that right always exists to top up the investments that have been done at the incubation stage or the seed stage. Then what kind of exits will be there? What will happen when there is a sale or a buyback or an IPO or a liquidation, in how much time that should happen? And like we said, the most critical aspect is condition precedent and condition subsequent. Both of them are a part of the SSA. what precedent, which means is that it will basically be the conditions are supposed to be finished prior to a call for money, right? Unless those are done, the call for money cannot happen. And that's why there is a certificate of condition precedent which needs to be given by a founder to the investor that we have completed all what was required to be done as a part of the SHA. What it could have is there could be deemed CPs, like we call them CPs, deemed CPs like authorized capital needs to increase, board meeting needs to happen. They are coming through the law. But there could be certain CPs which should come through due diligence process. There's a non-compliance that is found and that needs to be closed before call for money happens. So that is why along with the SHA, the DD happens. And whatever is the finding, some of it will become condition precedent to be closed before the call for money can be done. And then lastly, there is increase in authorized share capital. There's appointment of valuer. All those are kind of deemed CPs that will exist on the agreement. And then condition subsequent is post the call for money. Now the money has come in the company. Condition subsequent is important because the utilization of the money is dependent on it. Even the law says that you cannot use the money unless you have done the allotment. So company law is pretty straightforward. Unless you file the form to ROC for the allotment, money cannot be used. One of the most common non-compliance that we see where founders raise fund and start utilizing it even without allotment, or they raise funds not in compliance to how they were supposed to be done. We'll look at certain case laws in next few slides. And that's where it kind of, as I said, right, as far as going, it's fine. But when the growth path comes on, then we realize a good corporate governance could have expedited that scale and growth. So there are pre-money and post-money compliances. Pre-money is mostly your CPs, post-money is your condition subsequent. You need to increase the authorized capital of the company. There is a lot of secretarial compliance to be done. In most cases, a valuer report is needed, which needs to be approved in a board meeting. You need to have a Startup India registration to avoid the angel tax. This is very critical. You need to have a separate bank account to get the money, right? If you're doing private placement or using Section 42, you cannot have the money coming in the same account as your operational account. Open a separate bank account. Don't use the money unless post-money compliance is done of allotment of shares. Then you do further secretarial compliances and receive the investment in your designated bank account. Still can't use the money, right? As I said, you did the call for money, money is in your account, you still cannot use the money unless the point one of post-money compliance. You've done the allotment of securities and filing within 15 days of before utilization of fund. You need to file this form PAS3. Unless you do that, you cannot use the fund. In exceptional cases, we have to take a call where it's more of a business decision that money has to be utilized and PAS3 is not filed, where we say that, oh, we've done the allotment today, but we have been given 15 days to file this form or X number of days to file this form. Why can't we use the money? But the law is very clear. It says they need to file the form. So there could be an interpretation anomaly here, where some people might say that if once you've done the meeting, go ahead, you have 15 days to file the form. But we are very clear that unless the form goes through the ROC, you cannot use the money. Then if you raise money from foreign investors, you need to do FEMA compliance. One of the most common skips from early stage founders, we don't get the shares stamped. And in any case, it's a pretty tedious process from state to state. There is a penal provision, hearings do not happen. But from a diligence standpoint, at least applying for the stamping is very, very critical. Usually what we see is DD report comes in, stamping is missing, oh, we'll get it done now, all of it together. A typical process that's followed, but as we said, a good corporate governance is at every stage, just keep on completing this step. Another important aspect is, we just need the CS for the annual filing, that's all. We don't need corporate compliances the way we need to, which the law says. Who's checking? Nobody's asking at early stage. All these are misconceptions. Things are changing very, very fast. Things are becoming transparent. Expect a little bit of, we are already looking at it. We know there is a lot of buzz around that. There is GST verification that's happening across. ROC MC is also on that line. There are a lot of case laws that are coming in every now and then. So it's okay not to maintain registers early on. We understand from the point of view of cost, time, that we can do it at the year end. But as we said, from incubation standpoint, making that as a corporate governance structure that it's not going to take a lot of time, it's not going to take a lot of cost. Why don't you update it right away? Have all that is needed right from day zero. That will help you to, as we said, close down faster, grow faster. Then there needs to be amendment in the AOA, like you said. The deemed voting rights do not come by default in couple of instruments. You need to amend the AOA, and then there could be certain other compliances. But the first compliances is very critical. Don't use the funds unless you've done this allotment. Just a little bit of on the incubation part. You don't have a proof of concept. What happens? Can you go to angel VCs? But you still want to try out. You have an idea in mind. Where do you go to? You go to incubators. Will banks give you loan at this stage? No. They need, even if they are doing collateral free financing, they need certain basic things. Where do you go to? You go to the incubator. There is a Startup India seed fund as well, which is kind of built around and is being channelized through the whole ecosystem through the incubators. There's fund of funds which is giving money not directly to the startups, but it's getting rotated through the channel to the people who are existing in the channel. And startup needs this fund to conduct proof of concept trials, right? At that stage where there is acceptance to failures, right? It's more of an experiment phase. It's more of a product trial phase. And at that stage, you might not find angel investors. That stage, you find early stage incubators that will want to take that risk with you. Maybe not with money, but at least giving you the kind of resources that you might need to do it, which is the next, the slide after that. They might not invest, but they still play a very, very critical role in mentoring, giving you advisory, creating that network, sessions like these on valuation, modeling, fundraising, and of course the infrastructure support. Even if there is no money, these things are very, very critical, which the incubators provide to the early stage incubators, which exist the stage at which we talked about. And the one thing that comes there apart from the equity or CCPS investment is there's plethora of grants that are available, which most of the research organizations kind of take to conduct certain experiments, to bring out certain patents and intangibles. Again, this is governed by Startup India Seed Fund Scheme. There is going to be a specific criteria which needs to be fulfilled. Even at a proof of concept, there still need to be a basic requirement that needs to be done. Incubators will enter into an agreement with you for the kind of control over the IP, what kind of prototype you are building. You will get a grant. The grant is typically not, it's neither a revenue, neither it's your capital, it's a grant which needs to be accounted for based on the accounting standards that exist in the Indian ecosystem. There will be a duration of the grant in which you will have to utilize it. You will have to give a UC, a utilization certificate, to the incubator to ensure that the grant is being utilized in the way the agreement said. And if it is not utilized, you need to refund the grant as well. That there are grants which are not repayable, but there are grants which will ask you to be repaid if you don't utilize it. So in that stage, a CA certificate might be needed, but there is no statutory filing that is needed. It's not a fundraising round. It's more of a grant, but as I said, even from the grant aspect, from a corporate governance aspect, the controls and the mechanisms will still need to be followed. Whether the UCs are coming on time, are the UCs having the supporting or not? Is it solving for the purpose for which the grant was given? What are the learning lessons from the grants that were given, which should be included in the agreements that we now have? So there is a standard set of agreements which we do with incubators. We did 10 grants. We had learning from those 10 grants. Now we should go back to the agreement and change those. For an example, ownership of the assets. What happens if the company goes down? What happens if the project is stalled? All those things will need to be evaluated from time to time, from even the grant perspective, so that it becomes most effective. We've discussed this slide. Consequences of non-compliance of statutory filings. There is, of course, legal penalties and fines. The investor might not say no to you for these non-compliances, but it does leave an impact on a high level in terms of what kind of corporate governance structures the founder has. So the first thing that will come as a reaction is the team needs a very strong financial controller to be in place. So you might lose that flexibility, which is good and bad, both from the founder's perspective. On the reverse side, at an incubation stage, the thing that needs to be done is building that culture of legal and financial, and I mean saying that finance is not a low-hanging fruit. It is at equal par with I need a marketing co-founder, a tech co-founder, I need to solve for technology and all of those things. This can lead to it's a non-compliant. I don't have a co-founders agreement, or I didn't have a term sheet. I statement to the standard FHA that was available on the website. It will lead to investor disputes. It will lead to co-founder conflicts. It will have those highest basic two common reasons for failure that comes in, because we didn't invest our time, and it's an investment. It's not an expense. We didn't do it at early stage, which we should have done. And there is a loss of time and trust. Forget about loss of money. Time and trust are the critical parameters, right? I personally will keep them at first apart from money, because time and trust can still get you money. If you don't do well, just managing that money in terms of compliances, you lose both time and trust, and that's the end of the game. And then in the next due diligence round, again, same sentence again, do faster call for money. You cannot do it if you face, so in current round, some of the current rounds that I'm kind of consulting, the biggest problem there is lack of financial acumen at an early stage, crores of revenue, and now they're struggling to answer the DD questions. Now, of course, the investor that's committed to the team, to the idea, might not look at that DD report from a perspective, I don't want to invest in the company, because the decision that has been taken is not just on the historical things, it's also on what lies ahead. But he will still want to have further round of discussion, have more CPs, put more controls in, command the negotiation, and then go forward. So again, faster call for money, higher growth rate. If you want to do it, have a good corporate governance, please. Some of the penal clauses, incubation stage, we might not even look at those. These are late stage companies, but of course this has a repercussion, because whatever happens at this stage is a ripple effect to an early stage in the organization. Directors being penalized for not following like what we just discussed, the CPs and CS were not followed. Again, levying a penalty for not completing the registers. If you see the point number 4, it's a pretty basic, right? We don't have the registers. 90% of startups don't have statutory registers. It's okay, but look at the consequence. I know it has happened at a late stage, but why not start today? Because at that stage, then you don't need to go back and solve for things. You already have a lot of control mechanism in place. Again, as we said, you need a separate bank account. 80 lakhs of penalty on 5 directors because there was no separate bank account. This is very, very critical thing. These are very simple things, very critical things. But sometimes in the hindsight, we ignore it because finance is the low-hanging fruit. Like we just said, what incubators can do. Perfect session today. It's going out to a public at large. What else is needed is an in-depth session with the cohorts. Dedicated session where you can monitor and do KPIs around such sessions, whether they grasped it, whether they have been able to understand what's needed, is it giving the right result? We need to go one step further. Best practice for incubator, this is the first one, right? Help us in spreading this message that finance is legal is not a low-hanging fruit. Keep it at par with other things early on. Exercise your rights. You have an affirmative right, you have a reserved right of asking for informations. Get that data from the startup founders, get them into the habit. There might not be a data, but get them in a habit of sending that MIS early on, whether it is even nil, right? So if you talk about the compliance framework, if you don't have any GST data, does the government say don't file return? No, they do ask you to file the nil returns. There's a mechanism to it. There is a legacy to it. So even if early on there is no data points to look at, getting into the habit of communicating what is going on is very important at early stage, where incubators and incubatees both can play a very, very critical role. Build a compliance culture through mandatory disclosures, right? Tell us what's happening. So at times the culture develops, यार मत बताओ मतलब क्या करना बता के फालतू में टाइम वेस्ट होगा, फालतू के क्वेश्चंस आएंगे, versus यार बता के देखते हैं, हो सकता है they might have some more insights for us, maybe we are not doing something right. So we need to build that trust at both ends, right? The incubator has that skill to help us. We have trust on the founder that they will share the data with us. Then do a DD at early stage. Incubation stage, seed stage, DD doesn't make sense. I fully buy that argument, but at least do the basic DDs. What kind of backgrounds that the founders have? does the incorporation, post-incorporation compliances have been done or not? Pre-incorporation compliances are in place or not? IP is protected or not? All those things can still be done at an early stage. Same for the legal side of the story. I'd hardly have one agreement with the employee. There is just one employee in the company. Okay, do you have a co-founders agreement? What are the templates of your vendor agreements? What's your employment agreement going to say? All that can still become a part of your early stage legal due diligence. And then, of course, looking into the management team expertise, is the product having is the minimum viable product available? What kind of scalability can come in? These are all basics. All this, if we can kind of amplify through the incubation ecosystem, we are pretty sure that it's going to have a domino effect or a ripple effect across the startup ecosystem in the country, where at early stage we'll kind of create a noise where why this is important now, even if there is not much of a data point, and how it is going to help you in future. Of course, the importance of due diligence, there is a risk mitigation. You get to know things faster. Your financial viability is established. You get to know whether the corporate governance exists, there is compliance with regulations or not. And of course, it creates a healthy atmosphere of reputation and brand value at both ends. So DD is important. We recommend that even at early stage, a standardized small DD should definitely be done. And closing note before we go into the questions, we've talked about these three things. We'll kind of stress on it again. We can read the word investors as incubators also. So closing precedent as a part of the SSA, which is a part of funding exercise, should be very strictly followed. Just the certificate from the founder should not be sufficient, where he says, oh, I have finished all CP, send me the money. Have all the attachments, all the Google Drive folders with you, where it is established that all CPs are closed. It's okay to call for that data because you're a party to the agreement. You can have a record of that data point. It's a public document in any case. All the DD observations should be closed. It's just the certificate should not be sufficient. From founder's side, that the consciousness should say that if it's a CP, it needs to be closed. We just cannot go around to have a faster call for money. Close it because that's what the intent of the whole DD exercise was. And then do the call for money. And when the money lands in, which is the closing subsequent, there the story doesn't end. There is a lot of compliances still to be done. You cannot use the money unless you allot. Take the stamp, get the stamping done, obtain certificates. All of that is very, very critical part, where of course there could be service providers who are aligned to do that job. But at an incubation stage or an angel stage, it's okay to have a little bit of control over there, just asking for the information, because that kind of propels all the full cycle where service provider, founder, and investor are in closed loop and everything will close. And finally, do exercise your information rights. Ask for projections, ask for MIS, ask for compliance reports, get that data from the founders. It's only going to give a reflection back at the startup ecosystem of what's going right, what's going wrong. And it will help to pivot and change the direction the way it needs to be done. So just a concluding remark before we go to the questions. Fundraise is not just term sheet and call for money. Fundraise is a pretty lengthy corporate governance exercise to be followed by the startup founder and to be supported and substantiated by an incubator. Even at an incubation stage where incubator is putting in the money, ultimately it's not just incubation money, it's kind of a fundraise round itself that's happening, maybe at a small scale, but nothing changes, compliance still remains the same. So I will go on to the questions that we have. Vijay sir, you want to me to take that from the chat box of the Q&A, or how is it?
Yeah. I think Akash is also there, so we can coordinate. We can start off with that. Also, I think Sambhav, what you can put up your last slide where your contact details are there, so that many incubators who are part of it, even the startups, they can get in touch with you guys directly.
Yeah.
I think all the participants who wanted to address their queries, they can raise hand or put up in Q&A. We'll start off now. I think Akash, you want to read out some of them?
Yes, sir. Also, there is one of the question. Can you explain through an example what is the cap and floor valuation?
Okay, fine. So Let's take an example. I have today started off a company, raised a seed round at a 5 crore valuation. I raised about 50 lakh rupees, 10% dilution. Unfortunately, the traction is not that great. The market is still developing, and my revenue numbers doesn't give me a good multiple to establish of what my next valuation can be. It can be 30 crores, it can be 50 crores. So what I will do is I'll go out in the market and I'll say, see, I don't know what my next round would be. It would be way beyond 50 as well if I'm able to establish some traction. But since you guys are taking a risk, what I can do is I'll give you a floor and a cap. Floor is irrespective of, so if floor is 30, in this case, floor is 30 crores. So if I raise my next round at 20 crores, because you had it, that in that case, nothing changes. You get the shares at 20 crores. So you invested money today, but you will convert at 20 crores. What happens in case I raise my next round at 40 crores, which is between the floor, which is 30, and the cap at 50. So I'll get at 40 crores, but because I invested early stage, as I said, in CCDs, in CCPs, there will be a discount to the next price. So typically say 15%. So what will happen is I will get converted at 40 crores, but I have a 15% discount. So though the company has raised the next round at 40, because I invested at an early stage in a convertible round, I get a lower valuation than 40 crores. Right now, let's take another example. So we've taken two examples in floor and cap. One was lower than the floor, two is between the floor and the cap, and the third is I raised investment at 100 crores. Right now, everything went well, and my next round valuation is 100 crores. So I had an investor that invested at the earlier convertible round where there was a floor and a cap. Because there is a cap of 50, they will get converted at 50 only, irrespective of the next round being 100. Because there was a cap for them for conversion, they get converted at 50 crores. So that's how a floor and cap typically functions, with a discount rate that's given to the investors who appreciated that round.
Okay. So the next question is, what is the limit for foreign investments? So I think he's talking about the sectoral cap.
Yeah, so it depends on sector to sector. I'll pick up two sectors and I'll kind of, and then you can go back and do a little bit of research. So EdTech has no restrictions and any amount of money can come in. There are typically two routes. One is automatic route, one is approval route. There are few sectors where it's an automatic route without restriction. The only thing you need to inform the government that we've got an FDI from a foreign company or foreign investor. And since we are in X space, which is under automatic route, we are just telling you, पैसा आया और हमने पैसा share allot किया किसी government को. That's called an automatic route where sectors like fintech, edtech are there, right? And then there are automatic route, then there are approval routes. So to some extent, I might not have a very detailed analysis of what today exists. So say like defense was a sector where there was restriction that you cannot have more than 51%, which I think now has changed recently, where we are seeing a lot of drone companies coming in, where if you were supposed to get an investment in the defense sector, then ideally you will have to take, so assume that say defense is in an not an automatic route, but an approval route. You take the approval first from government that we wish to have investment from X in this sector. Once that approval comes in, then you can do it. And then also there will be a restriction of, say, in this case, 51%. So you'll have to ensure that the holding of that investor does not cross 51% at any point of time. So different sectors have different approval rates, but more from the startup ecosystem perspective, almost all of the things that we think about are falling in an automatic route. We will be happy to share the list later on to the community.
Yeah. Thank you. One more question from Rashmi. What factors should an incubator consider while deciding the floor and cap figures for the early stage startups?
Good question. And as I said, right, its valuation is more of an art than a science. There is practically no metric based approach or a scientific approach to this. But usually if I have to give my personal insights into this, like in case I am not able to gauge what kind of traction the startup will have, what kind of revenue they will actually achieve in terms of top lines, what kind of margins they are able to achieve later on. I'll use some ballpark estimates, good, bad, work. I mean, in terms of what could be the worst, what could be fair, and what could be the best, and then average it out and then do accordingly. So, for an example, assuming that on a balanced case scenario, a company will be able to do, say, 20 crores of revenue, and the industry multiple for them is 3x or 4x. So they are about 80 crores. So I'll take two approach, one down, one up, and say 60 is there or 70 is there, floor, 90 is their cap. That's what I can. I to be honest, I do have a very limited knowledge on it. I've never understood those dynamics scientifically. It's more of a negotiation that happens. So I'll give you a typical example. Recently, a startup was raising funds. They had X pre-money. It was a price round. It was X pre-money. They had an institutional investor coming on board, but they had a mandate that they cannot have valuation less than Y, which was a little bit 10-20% out from that range. They kind of increased that valuation just to become a part of that round. So as I said, it's more of a negotiation and an art.
Thank you. We don't have any more question as of now.
Just a
I
second.
would request the attendees if anyone has any other question.
There is one question from in the Q&A, which is already answered. Okay, fine.
In case anyone is looking to Sambhav, can raise hand. Sushant Curie replied. Sushant Sharma says, generally, what are the compliance post-acquisition where existing company is getting wrapped up and a new entity will get formed going forward?
What typically you are talking about. So maybe you can give us a little bit of more insights if you can raise your hands and personally ask this question, because I think the question is fully not complete.
Sushant, just raise your hand. Meanwhile, Deepak has been in the... Deepak, unmute yourself.
Yes. Yeah. So my question is there a possibility on an incubator to standardize a floor valuation, or does that have to be a case-to-case exercise each time you invest through a CCD? If say you do a convertible debenture, and do you require that a floor valuation decided for every company on a case-to-case basis? Or just to make life simple, a floor valuation can be pre-decided for all companies.
Pre-decided.
Sorry, I can't hear you.
Am I audible, Akash?
Yeah, I can hear you now.
Okay, so at incubation stage, I suggest it should be standardized the way it is in even developed incubation ecosystems, where X amount is given for Y percentage, right? As simple as that. There is no question asked, nothing of that sort. As I said, right, at incubation stage is very, very early on. At that stage, to go into the nuances of floor and cap, personally, I don't think it is going to help the founders any which ways. Instead, have a standard set, or we'll invest 10 lakhs for 7%, done, nothing else, or 10 lakh for 5%. If there is value in the ecosystem that the incubator offers, it's straightforward, because at that stage you don't have numbers, you don't have data. So, and if they have a data point, they have traction, then why are they coming to an incubator then? So I'm assuming that incubation will be very early stage, and there it has to be standardized. But even if it has to be a floor and cap, it cannot be standardized. It has to be case-to-case basis.
Okay. The only problem I see in that approach to standardize a floor valuation, I mean, of course, it makes life easy for an incubator. They don't have to negotiate the deal structure every time whenever a new funding opportunity comes up. But then when the company goes for a valuation report, if there's just one, let's say a service provider or a register valuer associated with the incubator, you may find it difficult to issue a valuation report which is close to the floor valuation or anything associated. Then it's a problem to standardize it.
I don't think so, because we've been doing it day in, day out. As I said, right, registered valuer following the scientific method will never be close to what valuation should be, right? And it's always the case, right? To be honest, this valuation bit of it is something we are looking at Indian ecosystem because of trust issues. If you look at South Asia Pacific, there is no valuation. Middle East, there is no valuation. US, no valuation. The problem here is that we don't trust. And what is happening here in the whole of the ecosystem, nobody is doing the DCF first and then saying this is my value, which ideally should be the process. Because if your assumptions are perfect, at least 80% perfect, then what is the DCF should work? Some discount on that. So my DCF says 20 crores. Okay, give me a discount of 30% on that. That's fine. 14 crores is my valuation. It doesn't work that way. It is my value is 40 crores.
Other way.
Yeah, it's like my valuation is 40. I have half baked projections. You finish the projections and get me 40 crores. Unfortunately, that's the system today.
That's true. That's
right.
True.
So what we are trying to solve for is not what should be the floor. What we are trying to solve for is a culture and a trust issue overall. We don't need valuation. If it's as far as it's banking transaction, we don't need, but we don't have that trust system today in our ecosystem.
So my question actually arose because let's say generally at an early stage, startups are not connected to registered values. It's the first time that they actually try and get in touch. So incubator is the only contact point for them to find a registered valuer. If we refer them to a particular registered valuer who's been doing these transactions, but unfortunately, if it's a standardized, say your case, your example, 5 crores, the register valuer, would it be a problem for him to do that? Because ultimately, the valuation in that case has to be lower than the floor valuation. Because if I'm saying 2 years from now, the CCD, or 3 years from now, the CCD will convert at 5 crores in case of no funding, then the valuation that we're doing currently has to be lower than 5 crores. It cannot be higher than 5 crores.
We always do the floor valuation. So whenever there is floor and cap, we always do the floor valuations. So we don't do lower than the floor because ultimately you will convert at the floor valuation, right?
But can it also be a sort of a premium? Let's say if it's a 4.9 crore valuation, so let's say 10 lakh rupees could be a premium that the investor is willing to pay and convert at a 5 crore in case of no funding.
I get that. It's a pretty practical problem to solve for. Unfortunately, there is no straightforward standardized protocol to follow. We can touch base later post this call one-on-one on how we solve for it.
Sure, Sambhav. Thank you so much.
Better
Thank you
to
so much,
connect with
Sambhav.
Deepak.
Yeah.
Connect with Sambhav post. I'll share you his contact details.
Yeah. Like I would love to connect. Thanks, Sambhav.
Thank you, Deepak. Can we have Sushant? Just unmute Sushant. Sushant, over to you.
Thank you, Vijay sir. Hi, it was a very informative session. Thanks for all the information that was shared by you. I have a generic question. So I just wanted to understand once there is a company which gets acquired by the investors or by any third company, and we want to just wrap up the existing company and take everything into a new company. So what are the compliances in that? So I just wanted to have a fair idea about the same.
A very specific use case here where there is a restructuring in the company and there is an acquisition that's happening, right? So there is acquisition and restructuring both. Am I correct?
Yeah.
Now, this will call for creating a framework before you go into the execution, right? I don't know if you've already done it, but it will need to be looked at from a legal aspect, taxation aspect, secretarial aspect. And then somebody needs to give a go-ahead in terms of a professional opinion that this path is risk mitigated and practically possible. To straightforward say that, because it's not just going to be closure of one company and starting a new company. Within that, there will be a lot of things. Will the current promoter be also the promoters in the new company? How will the exits be given to the current promoters? Is it a slum sale that will happen from the current company to the new company? Only intangible is going or assets are also going? What happens to the liability? So these are a lot of questions that will need to be subjectively answered before we say this method is correct. But just to give you some bird's eye view, like I've already told you, whether you've already got a validation from a expert on this structure first. That is the point. Second, from tax aspect, have you looked at it, whether it's risk mitigated or we've left some lacuna open for an assessment to happen later on? How are the founders getting the money? Whether the founders are getting shares in the new company or they are getting a cash exit? Are they acquiring the intangible of the company or they are acquiring the full company? If they are acquiring the full company, why are they closing it down? So apparently it seems like they are acquiring some specific thing which they will take into the new company and they'll leave out the rest of the part of the old company.
Yeah, it's more like that only. And all the points which have been discussed earlier were completed during the due diligence part, and while conducting all the mandatory stuff. But I just got a fair idea which I wanted to have.
You can set up a 15-minute call later on just to
Sure.
manage your subjectivities.
Sushant, you can meet Akash at the incubator itself.
Absolutely.
Yeah.
Right. Okay.
Thank you.
So we have a lot of questions coming up, but there is
Yeah.
one interesting question which
Yeah.
I just want to read it out. What all compliance do we have to follow for the early stage startup with respect to founders and the co-founders?
Can you repeat the questions again?
What all compliance do we have to follow for early stage startup with respect to founders and co-founders?
With respect to founders and co-founders, the first and pervasive thing is a co-founders agreement. Get together, write down things, who owns what is the role and responsibility, how long you want to lock yourself in, what happens in case somebody goes out of the company, how will that be solved for, what happens in case of a dispute, will you be doing a democratic process, will you want to give veto to somebody, you want to bring in a former CEO later who is going to be the absolute authority to take that call. All that needs to be documented. That's the first thing. And then whatever comes early on in terms of legal finance, setting up the financial team, ensuring that you follow a milestone, you have an insight or you have a chart which says what is falling due in this one to be filed from legal and financial standpoint. Whether you want to outsource, whether you want to keep it in-house, and all sorts of those things are secondary. I mean, that's important. First, important from a compliance, and it's not a statutory compliance. No law asks you to do it. It's a basic practice that should always exist.
Great. I think let's take two more.
So there is one more question.
Yeah.
So please advise 2-3 main things to keep in mind during exit from startups. So this is from one of the incubator, I must say.
Is the incubator taking an exit or a founder is taking an exit? So I'll answer it accordingly.
So during exit from startups, so it is from Yogmaya Verma. So yeah, 2-3 main things to keep in mind during exit from startups.
Just a second. Can you unmute Rajni Rani? I think she has asked that. Yeah, Rajni.
Yeah, let's understand the question better a bit, whether it's from incubator or from the founder's perspective.
Yeah, that's from the incubator.
Great.
Understood. So basically, you've invested in an incubator and now you're getting an exit, say in subsequent round, right?
Correct.
So typically, again, it's pretty straightforward from the compliance standpoint. Most likely, it will be a secondary buyout. Some other investors will buy our share at certain valuation. So first thing that you need to look at is whether the valuation numbers are correct. What is the value that you've agreed to? Is it near to the current round that has been raised? Are you being given some discount on it? Is it just a random number? How is that come out? Whether all other investors are also tagging along. We discussed about tag along, drag along. Why are you taking an exit? Can you take a partial exit and still stay with the company? All those questions should be answered with respect to the valuation of the company. When the value is derived that, okay, we now think that we've made multiple that we wanted to, we want to take the money out and redeploy in some other startups. Then comes the point of documentation. The first is approved valuation report, which is needed from Section 56 for the Companies Act, the Income Tax Act. Post that, there are secretarial documentation. There is an SH4 form that needs to be signed and approved in a board meeting. And if it is a non-resident purchase, so assume your shares are being purchased by a non-resident, the company needs to do certain, and the investor also needs to do certain RBI filing that needs to be done. And then this SH4 form needs to be signed and presented to the board of directors of the company. Also, what needs to be checked is whether all the clauses of the previous SHAs have been complied with. in terms of transfer, whether right of first refusal or ROFO has already been executed and no objection has been taken for those or not. And then potentially you go ahead, sign the SH4, take the money into the account, consider your capital gain aspect of how you will be declaring it in your incubation books of accounts in terms of capital gain and redeploying it in new startups.
Thank you. And what would be the right or appropriate time to exit? Is there any standard
Again,
for that as well? Or
that
it's
again has to
totally
be a
up to-
standardized. For incubators, I firmly feel it should be a standardized thing, because incubators are not here to make money. Incubators are here for redeploying that money for more startups.
Correct.
There could be a standardized approach. We'll take an exit as soon as the Series A ends, or there's an opportunity where we are able to get 3x or 4x. That's my personal viewpoint. Or it could be we'll take partial exit and we'll take 70% exit and 30% will continue with the startup. It could be a pretty standardized approach. Plus, it could be a case-to-case based approach also, depending upon what kind of exit you are getting. There could be cases in which case you are not interested in the startup, and you in any case were looking for an exit, so you want to get out the first instance you get a chance.
Very rightly said, Sambhav. I think as an incubator, we also had done a partial exit in multiple organization, and that has given us a good.
Thank you. And also just quickly wanted to check, like if there's a startup who was transitioning from an LLP to a private limited company and they had some overlapping transactions during the transition. And now they were also part of the due diligence for a funding. So could that overlapping transaction become a point for rejection of the startup for funding?
Oh, I just answered this query for one of our portfolios this morning. As I said, right, investor is not investing in the past. Investor ideally should invest in the team, the execution capability, and the future. This is not something that should be a red flag. He will not invest. This will be a red flag for a condition precedent that have a financial controller employed in the company. Something of that sort will happen.
Thanks, Sambhav.
Thank you, Rajni. So we'll connect you offline with the Sambhav. You can ping me personally. We'll take last two. Shivani has been waiting. Monica has been waiting. Shivani, if you can just. Shivani, unmute yourself immediately. Monica followed by Monica next.
Hello.
Yes, Shivani, quickly, please put your query.
Yes, yes. So very good afternoon, everyone. Sir, my question is over here. I have even listed myself in the question hours. Sir, I wanted to know that we have signed a contract with a very renowned brand previous year. And it was on the basis that if we are going to use their name as powered by, we have to pay 2% royalty on the total turnover. But we never worked with them in collaboration, and due to some of the things, the things kept on going. It is an auto renewal contract for 2 years. So recently they called us and they were asking that we are going to ship some samples to Nepal. So I said that for international shipping we will have a different contract, right? So he played diplomatic and he told us that no, the contract is there, it has been changed. So sir, I wanted to know that I have not used their brand name till now. So if in case, they claim that we have used, how we can prove that we have not used their brand name anywhere till now?
Is it there on the website?
Hello?
Is the brand name there on your own website also?
No, sir, nothing. We have not mentioned their brand name anywhere.
You need a expertise of an IP lawyer here. To be honest, I might not have a right answer to this.
Okay,
It's
sir.
more of an IP issue versus a financial transaction issue.
Shivani, connect with my colleague Harshit on the same. Okay.
Okay, sir. Okay, sir. And second, sir, I have 3 questions. I'll just be very fast. And second, sir, that as being a very early stage startup, now we are working on the team building part. And we have like completed a turnover and worked in every field. But now we know that we need a team and we need to hire people. So on the initial basis that when we go and talk to very mature or experienced people for joining our team, and for example, so we want to hire a business development person with us. So in that case, what should be the initial policies over there, like ESOP percentage or profit percent sharing? So how we have to develop that criteria and principles to fix before anybody joining with us?
Look at it. There is a senior person joining you at a market price. Then for ESOPs also, you follow market standard practice. For an example, there was a 20 lakh resource, you had a 20 lakhs, but they will be a key resource to the company. So you give them a ESOP worth equal to 1 year of their salary, which is 20 lakhs. And it is vested for 4 years, quarterly vesting with a 1 year cliff. That's a standard approach, right? Say half year or 1 year kind of a thing. Now, second is there is a 60 lakh rupees of resource, very senior folk, and you don't have capacity to pay, but they are joining at 20 lakhs and they are taking a cut. But they are taking a cut because they want an ownership in the company as well. So in that case, they will want a higher, either they want a secondary from you or they will want a higher pool size from the ESOP pool. So they have forgone their salary. So maybe they will say we will need a equity or an ESOP for 80 lakhs or 1 crores, again a negotiation point. But typically that's how it will work. For a standardized approach, say half a month or a full half an year or a full year of a salary. And for very senior folks, again, this is very subjective question. That's what we follow is what we are taking. And for very senior folks who are coming to join you at a very early stage, deep discounting on their market price, then the ESOP values will be higher.
Okay, sir. And
Thank you.
okay, sir.
Shivani,
Okay, sir.
I'll connect you offline with Akash and Sambhav.
Yes, sir. Yes, sir. Yes,
And
that would be great. Thank you so much, sir. Thank you.
yeah, we'll take last query from Monica. Unmute Monica.
Hi, can you hear me?
Yes,
Yeah,
yes.
yes.
Okay. Hi, Sambhav. It was really a very nice and informative session, I would say.
Thank you.
So I have a query since this is a practice which a lot of the incubators follows. Like they invest in their startups lump sum amount of money in the incubity, and in that, and somehow what happened is like after some days or after some years they say that okay, we are we are doing nothing and we are closing down our functions and we want to close down our company, and parallelly they start another company in the same area, and in that case is the incubator is liable to ask the question and to raise some because they have invested a lot of money in that particular startup. How could they leave that money? I mean, this is my query. Yeah.
In fact, we tackled this in one of our portfolio startups. What happens is at times founder gets diluted so much that they lose the skin in the game, like we talked about early on. And then such kind of things start happening where they still want to continue, but they know that they've kind of messed up on their cap table and they need to sort this first. And then such kind of things take place where they forego their current cap table structure and they start fresh, which ideally is not the right way, where it could have been a formal mutual discussion with the existing investors first, which doesn't happen, of course, which we kind of forced it on the founder to be done. And that clause should be there in your incubation agreement itself, which you should lock them in that post-investment, say for 3 years or 2 years. You cannot stop legally from doing anything, but you can create barriers to it where you can put clauses in your agreement that no co-founder or no person of key interest should start a competitive landscape within 2 years from the exit of the company first. And of course, the second is this happened because the rights were not exercised at the right time. You have information rights. You should have got to know it very well in advance. Unfortunately, it doesn't happen. So now, at least if it's there, you should take the legal route, definitely. And the best case would be you get a stake in the new company, to be honest, which has been done because that's a balanced approach. You will let the founder work.
They denied to give the stake. I mean, this clause, of course, unfortunately not mentioned in the previous agreement, which was
Right.
And now they are like they do not interested. They are not showing interest to take our stake on, like taking us on board or likewise. So what is the right way? Do we send them some legal notice or so, or what should be the right way?
You had equity shares in the company, right?
Right.
You have a lot of options. I mean, you have a plethora of options to put a barrier. They will come to the, I mean, not the right words, but you need to bring them on the table for a discussion. There are a lot of options for that.
But they are showing their company that this company is already been bankrupt. We don't have money to pay back or something likewise.
No, that's just what they are saying, right? And that's not how legal functions.
Like we
Because
are
usually in the
Is
agreement,
the,
right?
has the company, did they strike off the company?
no.
Then it's a no-brainer, right? I mean, the first step is not done. If the company was bankrupt, close that company, take the approval from all shareholders, and then start fresh.
Of course.
The first step is not done.
Right. Okay, so as an incubator, we are eligible to take some legal step against the
We can discuss it offline, look at some documents and give you some ideas around that.
Sure, sure. Thank you very much.
Thank you, Monica. I think we are over time now. And let me just thank Sambhav, Akash, and Startup Movers team. And in fact, all my fellow incubators who were part of it today, along with the participants from various startups. I'm sure you would have got a lot of insights about the compliance side of it. Anyone wanted to get in touch with Sambhav and team, please, you can reach out to me, or their details were already shared. My email ID is there, and we'll be more than happy to address any of your query offline, connect you with the team, and looking forward for more association like this. Sambhav, thank you once again, and it was
Yeah, thank you for having us. Thank you.
we wind up for now. Thank you, guys.
Thank you.
Thank you.